In the span of about 2 weeks this spring, a country with one of the largest gold reserves on Earth sold off tens of tons of it in a single motion. Not a rumor, not a leak, confirmed on the record in central bank data. And the reason it happened is more important than the headline itself, because that tells you exactly what a government does in the final stage of a currency crisis, the stage right before the public notices anything is wrong. If you understand why Turkey did this, you will understand something about debt, currency, and gold that most people never learn until it's too late to act on it. Stay with me, because by the end of this video, a handful of numbers you've probably already seen in passing are going to click into place, and you'll see the picture whole for the first time. Before we go further, I want to know who's watching this. Drop a comment and tell me where you're watching from, and tell me honestly right now, are you holding gold, silver, or cash? No judgment either way. I ask because I want to see in real numbers how people are actually positioning themselves right now, not how the financial media says they should be positioned. Now let's get into it. Here's what actually happened. In late February of 2026, war broke out involving the United States, Israel, and Iran. Turkey, a major energy importer, was hit almost immediately by the two things that hurt an import-dependent economy the fastest: a spike in oil and gas prices and a surge in demand for US dollars as businesses and households rushed to protect themselves. The Turkish lira, which had already been fragile for years, came under intense selling pressure. Turkey's central bank, the CBRT, did what central banks do when a currency is falling too fast. It stepped in to defend it. First, it spent foreign exchange reserves, tens of billions of dollars, buying LRA and selling dollars to slow the decline. When that wasn't enough, it did something more drastic. It turned to its gold. Over the following weeks, Turkey sold and swapped somewhere in the range of 60 to more than 100 tons of gold, depending on which reporting window you look at, worth on the order of 8 to 20 billion. Some of it was sold outright on the open market. The larger portion was used in gold for currency swap agreements, where gold is temporarily exchanged for dollar liquidity with an obligation to return it later. Turkey's reserves, which had climbed to a record above 800 tons in early March, fell by roughly 10% in a matter of weeks. One of the sharpest drawdowns in the country's modern history, and one of the largest single-country gold reserve operations anywhere in the world in recent decades. By the end of May, data from the World Gold Council showed Turkey had become the single largest net seller of gold among all the world's central banks for the year. Now, here is the part that should get your attention, and it isn't the tonnage, it's the sequence. A central bank does not sell its gold as a first move. Gold is the last line of defense in a currency crisis, not the first. The order of operations is almost always the same, and it has been the same for as long as modern central banking has existed. First, you raise interest rates to make your currency more attractive to hold. Second, you spend your foreign exchange reserves, your dollars and euros, buying up your own currency to prop up its value. Only when both of those tools are strained, or when raising rates further would crush an already weakening economy, does a central bank reach for gold. Gold is the asset you sell when you are almost out of better options. So when we see a country moving to gold this quickly, the real question isn't why did they sell gold? The real question is, what does it tell us that gold was the tool they needed to understand why that matters to you sitting wherever you're sitting, holding whatever currency you're holding? We need to step back and talk about how money actually works, because most people were never taught this, and the gaps in that education are exactly where fear and bad decisions live. Let's start with the debt cycle, because everything else sits on top of it. Every modern economy runs on credit. Governments borrow to fund spending. Households borrow to buy homes and cars. Businesses borrow to expand. As long as income grows faster than debt, this works fine. Debt gets serviced. Confidence stays high, and the cycle continues. Problems begin when debt grows faster than the income needed to service it. At that point, a government or a central bank has a limited menu of choices. It can raise taxes and cut spending, which is politically painful and slow. It can default, which destroys confidence and access to future borrowing. Or it can inflate the debt away, effectively printing enough currency that the debt shrinks in real terms, even though the number on paper stays the same. Historically, the third option is the one governments reach for most often, because it's the least visible in the short term and the easiest to disguise as something else. This is the quiet mechanism behind most currency crises. It isn't usually a single dramatic event. It's the slow arithmetic of debt outgrowing income until the currency itself becomes the pressure valve. This is where the Federal Reserve enters the picture. Even in a story that's ostensibly about Turkey, the Fed sets the price of dollars through the interest rate it controls, and because the dollar is the reserve currency of the global financial system, that single number ripples through nearly every economy on Earth. When the Fed holds rates high, dollars become more attractive to hold than other currencies. Capital flows toward the U.S. and countries like Turkey, which need dollars to pay for oil, technology, and imported goods, find those dollars more expensive and harder to come by. When the Fed cuts rates, the opposite happens. Capital flows outward. Emerging market currencies get some breathing room and the pressure eases. Turkey's crisis this year wasn't caused only by the war. The war was the spark. But the vulnerability, a current account that depends heavily on imported energy, a currency with a long history of instability, inflation running above 30%, that vulnerability was already there, built up over years of exactly the debt cycle dynamics we just described. Let me tell you about a man named Mehmet Eden. Mehmet is fictional, but his story is built from a pattern that has repeated in country after country during every currency crisis of the last 50 years. So, pay attention to the shape of it, not just the name. Mehmet is 52 years old, runs a small textile export business in Istanbul, and lived through the 2018 LRA crisis and the 2023 crisis that followed it. In 2018, when the LRA lost about a third of its value in a single year, Mehmet kept nearly all his savings in LRA, trusting that things would stabilize the way they always eventually did. They didn't stabilize quickly. His savings and real purchasing power were gutted. By 2023, older and more cautious, Mehmet had shifted about half his savings into gold, the traditional store of wealth in Turkish households for generations, often held physically in coins or small bars passed down through families. When this year's crisis hit, his LRA holdings again lost value fast, but the gold held its purchasing power, and even as global gold prices dipped slightly during the period when Turkey's central bank was selling, Mehmet's holdings in LRA terms actually rose because the currency was falling faster than gold was. The lesson Mehmet would tell you if he were a real person sitting across from you isn't that gold always goes up. It's that gold doesn't answer to any single government's decisions the way a domestic currency does, and that's precisely the point of holding it. That brings us to the deeper question. What is gold actually in monetary terms? For most of human history, gold was money. Coins were often made from it directly. And even after paper currency became standard, that paper was frequently backed by a promise that it could be exchanged for a fixed amount of gold. That system, the gold standard in its various forms, effectively disciplined governments. You couldn't print money, you didn't have gold to back, which limited how much debt a country could quietly inflate away. That discipline ended in the version most relevant to us in August of 1971, when President Nixon closed the gold window and the US dollar stopped being convertible into gold at a fixed rate. This wasn't a footnote in economic history. It was the beginning of the entirely fiat-based global monetary system we live in today, where currencies are backed by nothing but confidence in the governments and central banks that issue them. Since then, gold hasn't functioned as everyday money, but it has retained its older role as a reserve asset, something governments and central banks hold specifically because it isn't anyone else's liability. A dollar is a promise from the US government. A euro is a promise from the European Central Bank. Gold is not a promise from anyone. It just sits there, scarce, physically real, and indifferent to whichever country's fiscal policy is currently under strain. That's why central banks hold it. And it's why when a country like Turkey needs liquidity fast and doesn't want to keep dumping its dollar reserves, gold becomes the asset it turns to. And this is where the picture gets genuinely interesting, because Turkey selling this year happened at the exact same time that most of the rest of the world's central banks were doing the opposite. According to World Gold Council data from the first half of 2026, central banks worldwide continued adding gold on net, even in the very months Turkey was selling. In May alone, global central banks added roughly 40 tons net, even with Turkey and Russia as the only major net sellers that month. Poland has been one of the most aggressive buyers, adding gold for 4 consecutive months and pushing toward a stated long-term target of holding around a fifth of its reserves in gold. China's central bank has extended a gold buying streak stretching back nearly 2 years. Kazakhstan, Uzbekistan, and several other nations have been steadily accumulating as well. Surveys from the World Gold Council found that a majority of central banks, more than two-thirds, plan to increase their gold holdings further in 2026, up from the year before. So, the accurate way to describe what's happening isn't central banks are losing faith in gold. It's the opposite. Most of the world's central banks are increasing their gold holdings as a long-term structural strategy, while one country under acute and immediate currency stress was forced to draw its gold down as a short-term emergency tool. Those are two entirely different stories that happen to be running at the same time. And if you only see the Turkey headline without the context of the broader trend, you get exactly the wrong impression. I want to pause here and ask you to do two things, because we're at the point in this video where the pieces start connecting to something bigger. First, if this kind of analysis is useful to you, take a second to like the video. It genuinely helps this reach more people who are trying to actually understand what's happening with their money instead of just reacting to headlines. Second, subscribe if you haven't, because I go through these macro stories regularly. And the final insight in this video, the one that ties Turkey, the Fed, gold, and your own decisions together, is coming and it's worth staying for. Let's talk about currency strength and weakness, because this is where most people's intuition misleads them. A strong currency isn't simply one that's worth a lot of another currency. Strength is really a measure of trust. Trust that the issuing government won't inflate away the value of what you're holding. Trust that the country's institutions are stable. Trust that its trade and fiscal position can hold up under stress. The LRA's long decline isn't really about Turkey specifically being unlucky. It's the visible symptom of a country running persistent trade deficits, heavy reliance on imported energy and inflation that has repeatedly outpaced the ability of interest rate policy to control it. Every currency crisis has its own local triggers, a war, an election, a commodity shock. But underneath the trigger is almost always the same structural condition, spending and debt that has outgrown the real economic output backing it. This is not unique to Turkey, and that is exactly why this story matters. Even if you've never set foot in Istanbul and never plan to. The United States, the Eurozone, Japan, and China are all running historically elevated levels of government debt relative to the size of their economies. None of them are in a Turkey-style crisis today, but the mechanism that produced Turkey's crisis, debt growing faster than the income and trust needed to service it, is not exotic. It is the same mechanism that has produced every sovereign debt and currency crisis in modern history, just at different stages of the process and different levels of severity. Let's look at the historical parallels directly because history doesn't repeat exactly, but the patterns rhyme closely enough to be genuinely instructive. In 1971, the Nixon shock ended dollar convertibility into gold, and the decade that followed brought some of the highest inflation the United States has experienced in peacetime. With gold prices rising more than 20-fold from their fixed 1971 level to their 1980 peak, as investors sought protection from a currency whose old anchor had disappeared. In 2008, the global financial crisis triggered a wave of central bank interventions, near zero interest rates, and unprecedented liquidity injections into the banking system, and gold rose for years afterward as investors questioned whether the flood of new money would eventually show up as inflation or currency debasement. Turkey itself has lived through this pattern twice already in less than a decade. The 2018 crisis, when the LRA lost around a third of its value over the year, with a single day in August seeing a drop of roughly 20% after new U.S. tariffs were imposed, and the 2023 crisis, driven by years of unorthodox low-rate policy in the face of high inflation. In both prior episodes, Turkey drew down reserves, including gold, to defend the currency. And in both cases, once the acute pressure passed, the central bank began rebuilding its gold holdings again. That's precisely the pattern we're watching play out a third time in 2026. By April, weeks after the heaviest selling, Turkey's central bank had already begun repurchasing gold, adding back tens of tons as pressure on the LRA eased. The takeaway from these parallels isn't that gold is a guaranteed short-term trade. It's that gold has repeatedly functioned as the asset governments turn to under duress, and the asset ordinary savers have turned to for protection when their own currency became the source of the danger across 5 decades in multiple different countries. Now, I want to introduce you to someone else. Her name is Claire Whitfield, 61 years old, retired school teacher in Ohio, entirely fictional, but her instincts are ones I've seen play out in real investors again and again. Claire doesn't follow currency markets closely and has never heard of the Turkish LRA. But in early 2026, after watching gold quietly climb toward record highs, she moved about 15% of her retirement portfolio into a gold-backed fund, mostly because it felt like insurance rather than a bet on any particular outcome. When gold prices dipped during the period Turkey was selling, falling more than 10% from their January highs, Claire panicked, checked her account daily, and came within a day of selling the position at a loss. Convinced the central banks are dumping gold headlines meant the whole trade was over. She didn't sell. A colleague who happened to understand the context we just walked through pointed out that the dip was driven by one country's emergency liquidity operation, not a change in the underlying global demand trend, and that central banks overall were still net buyers even that same month. Claire held. Within a couple of months, gold had recovered most of that dip and pushed toward new highs again. The lesson from CLA's story has nothing to do with predicting short-term prices. It has to do with the difference between reacting to a headline and understanding the mechanism behind it. The exact same event, Turkey selling gold, produced two opposite reactions depending entirely on whether the person understood what they were looking at. That difference in reaction is not just a matter of information. It's biological. And understanding this will make you a better investor than almost any amount of technical analysis ever will for. When markets move sharply, especially downward, the amygdala, the part of your brain responsible for detecting threats, activates before your prefrontal cortex, the part responsible for reasoned analysis, even has a chance to weigh in. This is an ancient survival mechanism. It kept early humans alive by making them react to danger in milliseconds rather than deliberating. But it is spectacularly badly suited to financial markets where the danger is often just a headline and where the correct response is frequently to do nothing at all. Fear triggers a flight response. The urge to sell, to get out, to make the discomfort stop right now, regardless of whether selling actually protects you. On the other side of the cycle, greed operates through the brain's dopamine reward system. Watching an asset rise activates the same neural pathways associated with other forms of reward seeking, which is why euphoric bull markets so often end in the kind of chasing behavior where people buy the most right before a top B, precisely because the emotional reward of everyone else is getting rich overrides rational risk assessment. Understanding this doesn't make the feelings go away. You will still feel the fear when your portfolio drops 10% in a week. But knowing that the feeling is a survival instinct evolved for a completely different kind of danger, not a stock ticker, gives you the ability to pause, breathe, and ask whether the fundamental picture has actually changed to change, or whether you're just responding to the oldest alarm system in your own body. Let's bring this back to the bond market and liquidity, because this is where the Turkey story connects most directly to the global picture, including wherever you are watching from. Government bonds are, in essence, IUS, a promise from a government to pay back borrowed money with interest. When investors trust that promise, they accept lower interest rates because the perceived risk is low. When trust erodes because debt is growing, inflation is elevated, or a currency looks unstable, investors demand higher interest rates to compensate for the added risk, or they simply demand less of that country's debt altogether. This is exactly what has been happening in Turkey for years, with borrowing costs remaining elevated as compensation for currency and inflation risk. But this dynamic is not confined to emerging markets. Developed economies, including the United States, have seen growing attention on the sustainability of government debt loads. And every time a major economy runs large deficits alongside high debt levels, the same question arises in the bond market. Will this debt eventually be serviced through real growth and responsible fiscal policy, or will it be quietly diluted through currency debasement? Gold's price over long stretches of history has tended to reflect the market's answer to that exact question. It tends to rise when investors grow skeptical of a currency's long-term purchasing power and when